Hi, Jeremy. How are you? So nice to see you.
Great to see you too. Thank you for having me.
Oh, what a pleasure. We connected at ValueX, Guy Spears ValueX, and
Yes.
we spent some time chatting there this year and last year. And I got to talk to you since, and I've been really looking forward to having you on the show. And I know you have a fascinating story, a fascinating career, and so much more. So I'm sure we'll have a lot to talk about. So thank you for joining me today.
Yeah, I'm glad to be here. I'm a big fan of your show, and I get a lot out of all the episodes. So I'm grateful to be with you today.
You gave me a lot of compliments about the show over the last few months. How it's kind of a Zen
Yes.
experience, and I think you said it's ego free, which I like the idea. It's like
Hmm.
I don't bring my ego here, and my guests don't bring their ego, and I think there's a fun and exchange that can happen when you create that kind of an environment of I'm here to learn, and my guests are here to share and have some fun. That's the point, and cool
Yes.
things can happen in that space. Jeremy, I want to jump right in. And you know that I love this question about the early days, childhood upbringing.
Hmm.
Can you share your story? I know you have one.
Yeah, I was born in the Midwest in Oklahoma, and I have three younger brothers. And my dad was in sales, and my mom was a teacher. I guess you could say we were lower middle class, and at some points we were probably lower class. My parents struggled with the four of us to make ends meet, and my early memories were always kind of worrying about money and taking on that anxiety that my parents had about just kind of the basics. But it was still a good childhood. And then when I was around 10, maybe 11, we moved to Southern California because that's where my dad's family is. And they had encouraged us to move to California and start over. And it was a rocky road. It didn't go as I think that my parents had planned. We lived with my grandparents for a couple of years, and then we found a small home to rent in a suburb. And I started school this fifth grade, and we continued to struggle, but it was in a different way. At least we had sunshine, we had better weather, and I made some great friends. Adapted to the Southern California kind of lifestyle. Started swimming and played water polo and tennis. But life was a little bit difficult, and it led me to question money and to think deeply about money and about budgeting and about how other people do it. I would see friends whose parents seem to have a little bit more money or disposable money, and I would think about it. What do they do for a living, and how do they make it work, and what's the difference between them and us, and is this something that is it possible for somebody that doesn't come from money to be able to do well, and all these questions we used to I used to think about quite a bit. And so I would say, the idea of money and getting ahead in life was something I started thinking about as a young person.
It's fascinating to me how we all have those early experiences, and it takes us some time in adulthood to look back and see how we got shaped in a certain way. And you and
Yeah,
I are in the
right.
investment world, and we make certain
Hmm.
decisions influenced by those moments in the past.
That's right. Well, and when I was old enough to get a job, I was kind of counting down the days when I could legally work. And as soon as I was old enough, I believe it was 15 and a half or something, or maybe even 14 and a half, I was able to get there was a certain type of part-time job I could get. And I started selling newspapers, so not delivering them, but selling them because that was a job that was offered to me. And I did that for maybe 2 weeks. It was a little rough. Um, Getting dropped off in a van, going door to door, was very uncomfortable, but it taught me how to communicate a little bit better. And then I started going around and asking the neighbors if I could mow their lawn or just do chores for them, and some of them said yes. And so I would just find little things to do. And when I was 16, I worked at Blockbuster Video. And at one point, I made pizzas. I delivered chicken one summer to pay for a foreign exchange program that I wanted to do. So, I always worked. I found myself around, being attracted to other kids that were similar to me, but were also interested in business and were finding little ways to make money selling things or doing part-time things or helping somebody move or just really anything. And I had friends that were buying and selling things at the swap meet. I had friends that were, knew people that were helping out at a furniture store. And so I was just kind of bouncing around looking for to learn as much as I could about business. I didn't just want to, do just, it wasn't just money. I was interested also in how does this person make money? How is this business scale? Learning about small businesses. So it was just an interesting period, developing, coming out of that background and into adulthood. And ultimately, I read Making of an American Capitalist about Warren Buffett, and it just changed my life.
What a book.
Yeah.
Was this the first book that you read about investing?
Um, no, not really. I was interested in investing, and so I had read about venture capitalists. I had read about private equity guys. I was familiar with the KKR story. Private equity had always attracted me. The idea of buying a business was always very attractive to me. I understood the economics of that, and I wanted to be a buyer of a business and not a broker of a business, for example. I remember learning the difference between investment banking and a principal, and learning that, oh, a modern day investment banker is just a broker. They're not the person actually buying the business. They're representing the buyer of the business, and that's who I wanted to be. And what made me nervous about the stock market is just the ups and downs of it, and I had just couldn't square, what how can you own this? It just goes up and down. Like, you would be so distracted. And it wasn't until I read about Buffett that I understood, which led me to Graham and reading, reading about Graham and seeing, and seeing that there was somebody extremely successful who had built his career around looking at a stock as if he was buying the entire business, and just seeing the
Right.
volatility as just part of the game, and the price you pay to get a deal. And so that changed my life. But I had read about Soros. A lot of these investors, a lot of famous investors at the time, I had read about, kind of searching for my own path, because I knew it felt right to me, but the nuances of which vertical, I guess you could say, to go into, and who to really emulate. I was kind of looking for a hero. And like a lot of value investors, I had heard about Buffett, but I read that particular book. Um,
Right.
it just felt like I had found my calling.
It looks like you already brought this understanding that you're buying pieces of businesses when you thought of the stock market, which was something that I discovered in Peter
Yes.
Lynch's book, One Up on Wall Street. I was taking all those advanced courses, options pricing, very sophisticated models, but nobody actually sat down with me and said, all of this noise aside, what you're trying to do is buy small pieces of businesses. And the thing that really resonated with me is that it doesn't matter if I have $1 billion or if I have 100 or $1,000. I'm treated as a shareholder the same way, right? I mean,
Yes.
$1,000 can be more
Yes.
important to me than $1 billion to the other person. So it's all relative. But I get to participate in their success as an owner. It just
Yes.
blew my mind
Yes.
at the time, and I could never look at the stock market the same way. I want to
Yeah,
jump
I
in and
feel the
ask
same
you
way.
about I had a feeling you might feel the same way. I want to ask you about how you got started in investments because your story is unique, and I really appreciate that you joined the industry without ever working for anybody or any firm in the investment world. I know that on the
Hmm.
public market at least side, and you can specify a bit more. The reason I bring it up is that I worked at a couple of firms, none of the large ones, but big enough to have 100, 150 people. And when
Hmm.
you leave such a large environment, you kind of have to, well, obviously you bring a lot of experience and so on, but there are certain things that you have to shed and leave behind, especially if it was a big, big institution, and unlearn
Yes.
and relearn. You didn't have to do it. You just jumped
Yes.
in and this was your world. Tell me more about that experience.
um, so I graduated during the dot-com bust. I graduated from college during the dot-com bust, in San Diego. And
Hmm.
San Diego is far from a financial capital. I had read that Lou Simpson was operating out of San Diego, actually in Rancho Santa Fe, and in a nondescript office. It talked about it in one of the Buffett books. I don't remember which one. And so I just, it's a small community. It was even smaller at the time. So through asking enough people, I was able to get an email maybe it was even the address. So I wrote a letter to Lou Simpson and I got a response from his one employee who now runs a fund in San Diego, saying, "Hey, we don't hire people. We can't help you, but we'd love to suggest, that maybe you should go to the East Coast and you should get out of San Diego and go work for a firm." And I remember in the email or the letter he wrote back that he even suggested a couple of names. One was in Connecticut and one was in New York or something. I thought it was just so far from where I was. I didn't have any money. I was kind of, was delivering food or something, and I was just really looking for that right first job in investing. And I interviewed him with a couple other small, maybe RIAs or something, and I just couldn't find anything. And a friend of mine had a friend's dad had a friend who had just sold a business to Honeywell, and having dinner with my friend's dad. He said, I have this friend. I think you should meet him. He's an incredible entrepreneur. I just think you would like him. I think you would learn a lot about business. You should go meet him. And so I went and met him. And he turned out to just be this fantastic human being. He had a real zest for life. He had sold a business, like I said, to Honeywell maybe 2 months before. And I told him about my ambitions. I said, I want to learn how to become an investor, and I'm looking for business experience. And he said, why don't you come work for me? And it was a fantastic experience because it was integrating this small company into the bigger Honeywell. We manufactured home security equipment, design and manufactured home security equipment that ultimately ends up in like maybe an ADT home security system or something. And I just admired him. I admired the way he thought about business, the way he approached things, the way he could articulate very complex business situations and make them very, simplify complex business situations. He knew how to take risk. He knew when to cut his losses and move forward. And he was just somebody I admired and I wanted to work for. And he said, look, we are not doing any big M&A here. We're not going to be like a Wall Street firm, but if you can kind of do everything, just figure out a way. You can be a fly on the wall and come to meetings with me and kind of just do whatever you want. But I need you to hustle. If I need you to manage engineers, you figure it out. If I need you to make a sales call, you make a sales call. If I need you to clean the clean the office and clean the office, kind of do everything. And so I did, and it was just a remarkable experience. And about a year and a half in, um,
Mhm.
there was a dispute. The management, or he got into a dispute with Honeywell over the compensation agreement. There was an earnout that had kind of gone wrong, where they reneged on my understanding, they reneged on the original deal that they had, and they realized that the earnout was going to be paying the team too much money. And so he decided to quit and go compete against that business. And that was kind of at a time where I was sort of contemplating, do I go to business school? I had gone to Columbia Business School to sit in on a class for a few days and kind of thinking about the investment program there. And he extended his hand and said, "Would you like to join this in the startup? And you'll be the small guy again." And I didn't have a lot of money to invest, but I could earn stock. And he said, "This might be your opportunity to really learn business, because we're gonna build and we're gonna compete, and you're gonna see firsthand what it's like to go from something to nothing." He had everything on the line. He had mortgaged his home. He had kind of really gone all in, and so had everybody. Kind of the key people had done the same. So I took that path, and it was a little bit scary. A very, very basic salary, minimal salary that you would probably laugh at today. I mean, I don't even know how I survived on that, and earned stock and had the right to buy more stock with that small money, and I did, and we grew it, and we made several. We bought a couple of companies, and ultimately we're very successful. We sold the company to a large private equity fund, um, and after that, that was kind of the beginning of the financial crisis. And although I stayed on maybe a year or two too long after that, it gave me the runway. I earned enough to have the runway to kind of start investing for myself. And my original idea was to try to buy private companies, do corporate divestitures. And long story short, after looking at corporate investors and making calls into public companies, looking for divisions of, broken public companies that maybe were over leveraged, um, I looked and I saw the public companies themselves that I'm calling in on. These are the better deals. We'd be better off just buying the stock of these companies because they were just cheap. And after GFC, it was years before everything kind of returned to normal, as you would probably remember.
Right.
If you were
Hmm.
really bargain hunting, you could buy things for, I mean, even 3, 4 years later, you could buy stuff really cheap
Hmm.
because there was just a general fear of the market. And at the same time, so much money had flooded into private equity because the markets couldn't be trusted anymore,
Right.
so to speak.
Hmm.
That you would have scenarios where you would have a very low quality private business trading for 2 to sometimes 3 times the multiple of EBITDA that a
Hmm.
much higher quality business would trade for in the public market. And the excuse flipped from the premium that you would get of a public company flipped to a discount. And so for a long
Right.
time, there was a discount for a public company, especially if it was a smaller company that was publicly traded because, hey, there's no catalyst for it to go up. We were always on the brink of the next recession. I don't know if you remember the double dip. And then we had the European financial crisis. There were these rolling periods of extreme uncertainty. And because I didn't come from the industry, I would just do a ton of work on a small company or even a big company and be like, what are you guys talking about? Like and this was before, podcasts and the flow of information. I didn't pay for sell side research, so I didn't have that flow of negative, the world's going to end, double dip. I remember Buffett going on TV and saying, guys, there's not going to be, and it was a very rare moment for him of kind of talking macro. He said, I don't believe we're
Right.
going to have a double dip. A double dip meaning
Uh-huh.
a double recession. And
Right.
but analysts would say the gross margins are skewed. It's just because they fired everybody. It's a reason companies look more profitable than they are. They're going to have to hire at some point, and profitability is going to go down. It was always just it was a very very fearful period. Late 2011 was also a famous period of a debt ceiling negotiation where the markets were just up and down, 5 or 10% in a month, and
Hmm.
not having that background and not being, I was sitting in a bedroom, my second bedroom in my apartment on the beach, and sitting there with no shoes on, just reading everything I could and making calls to employees and finding people to talk to in those industries, going to trade shows. I thought, no way. There's no way that this company should be trading for 3 or 4 times, EBIT or whatever the case. And so um, made the switch to instead of trying to look for private companies to look for stocks, and organized a partnership, public, a kind of what we call like a hedge fund, I guess, but long only. And had one original investor turn into two, and the three of us kind of put our money in and started investing with, definitely less than $1 million. So that's how it started. And that's in those early days. I do believe that the returns that I made, which were exceptional, then, obviously, the longer you do this, the harder it gets. But those early days were just because I did not have the influence of the typical kind of bullhorn, fire hose of information coming at me about the macro and about the Fed and about all those things that unfortunately I'm all too aware of today.
I write a lot about independent thinking, and it's such a powerful idea, but it's so hard to nurture it in this world. And if you leave a large
Yeah.
institution, in that environment, there's a lot of smart people around you with an opinion. And I think it's very hard to sit down and say, this is what I really think, and this is what I was told, and I made it mine. And I think you had this huge
Yes.
benefit of not having any of that noise. So you didn't even have to, investors talk about developing filters, what can reach them. You didn't even need the filters because nothing was really reaching you. All you were doing was sitting on the beach without your shoes and doing all the reading, which is
Yeah.
really what
Yeah.
investors
And
should do. It's a
working.
very monk
It was it
like
was a it was a very
experience.
yes, a very spiritual experience for me, sitting in that environment, very, very far from New York, but also enjoying the sun. And I remember working all the time and just fascinated by it. No matter what was going on, I had value line. It was just kind of this weird period where you could still screen stocks and where you could buy something cheap and it would just go up. And so I
Mhm.
felt like I imagine it must have been like that after the dot-com blow up when
Mhm.
famous investors like maybe like Eddie Lampert or Balpost was coming up, and those guys like were just being able, they could just kind of like shooting fish in a barrel. Or Buffett talks about shooting fish in a barrel in the 50s. There was that kind
Right.
of euphoric period of time where you could do that, and you just
Hmm.
and I guess you just had to have the courage to buy the business and not worry if the stock went down after you bought it.
You're touching on something fascinating because people join the investment world when things are really exciting, when the neighbor is getting richer than they are. And this is the time where you should avoid the market or be very cautious. And you highlight the fact that the
Mm-hmm.
opportunities arise the day after, once things collapse. And dot-com bubble was a very memorable experience for me. I was still at school, in college in Poland, but a small website started by a couple of students at my school had some Silicon Valley funding. And I was thinking they're throwing money at anything out there that has a dot com, even in the most remote places. So
Yeah.
these things
Mm-hmm.
come back. It rhymes. We've had a similar experience the last
Yes.
few years, and we're having probably now in some segments of the market where people get very excited. Peter Lynch had this saying that if he had to avoid one thing, is the hottest stock of the day. I'm paraphrasing, but something along those lines. And I think there's a lesson there, right? It's not just the things you buy, but the things that you avoid. I don't want to miss one point that
Yes.
you brought up that I think it's very valuable is that you had an experience running a business or seeing from the inside how an actual real business operates with its profits and costs
Mm-hmm.
and so on. And I think it's Buffett has this saying, I'm a better investor because I'm a businessman and the other way around. And so many people join the investment world and they never actually had a chance to operate or start or be a part of a business and see profits and losses and how the business actually operates and survives. And I think it's very
Hmm.
valuable that you got to see it. I started businesses since, and I noticed that I learned so much seeing it from the inside. Because as an investor from outside, you're reading the financial statements and you have all those ideas, and your expectations can be very unrealistic because you've never seen it actually, what it's like to try to push pricing up or to see your costs go up higher than you thought, to manage for a tighter period, like all those things. And it makes you
Right.
appreciate the work that the management does, not just in terms of impressing us with some quarterly earnings that I don't care about at all, and I'm sure you don't too either,
Hmm.
but how they navigate the business through some really tough periods
Yeah.
sometimes when the demand dries up,
That's right.
when the costs go up too high, right?
Yes.
When the competition starts you know, undercutting them on pricing and on and on and on. What's it really like to
Yes.
operate
Yes.
where everybody wants to take whatever you have? That's the competitive world of business we're in. You've been bringing up the
Yes.
environment, the beach, and the
Mm-hmm.
lack of shoes and all that. I'm curious about it because I notice a theme with a lot of investors. We get into investing because we want to pick stocks that go up, but I think eventually we start to appreciate all the other elements. And a big, big element, I know for Guy Spear, for Warren Buffett, for a lot of people, is what's what's the environment that serves us better? And you rearranged your life, and I
Mm-hmm.
know you spend more time in one place or the other, but you've been thinking
Yeah.
more about the environment where you can actually think and work. Tell me more
Yes.
about that, because I know you tried different places and different ideas when it comes to the
Yes.
environment.
Yeah. I mean, I've spent a lot of time in Europe over the last seven years. My family lives in Amsterdam, and I'll tell you this. I don't live on the beach anymore, but that was
Mhm.
kind of a time in my life. But it was an important period because it allowed balance that I think a lot of people in this industry don't allow themselves to have. They feel like they need to live in the epicenter of where the capital is or where the idea generation is or just where the other, peers are. And for me, I found, and looking at it almost in retrospect, it wasn't necessarily planned because that's where I lived before starting. That's where I had spent, most of my life at the time, was in Southern California. So it wasn't like I moved there to do this, but in retrospect, it, like I was mentioning earlier, it was very helpful to be in an environment where I didn't have peers, and I didn't have, when I turned off and went for a walk outside or went to a friend's house or even went on a date. We didn't have to talk all the time about the market. It wasn't just this constant pressure, because
Mhm.
it's a very, very hard business, and you're always on. You're always thinking about it. You're always, just because the stock market's closed doesn't mean that you're not thinking about it all the time. So, um, trying to avoid outside pressure and controlling your environment becomes really important to making rational decisions, especially during difficult times. And being in Europe is great. Amsterdam, in particular, is a really interesting city because you living here, people don't, it's not as materialistic of a society as maybe other major cities. People ride bikes. People are very thrifty. It's a very thrifty culture. You feel like you can kind of be who you want, and there's not a lot of people, in the investment, professional money management industry. There's not a lot of people running funds that, at least that I meet. There are some, but it's a world where when you go to a party, when we go to a kid's birthday party, if somebody even asks what you do, which is generally not a given that people even ask, and being
Uh-huh.
European, it's a very American question to ask somebody when you first meet them what they do
It
for a
is.
living. If they even
Uh-huh.
ask, it's not that they're, and you tell them you're in the investing business. They don't drill you on, okay, what's
Mhm.
Google's earnings going to be, or what do you think about Nvidia, or what do you think about Berkshire Hathaway, or what do you think about,
Uh-huh.
and it's just kind of like, okay, that's nice, and then they move on. And I like that environment. I like the environment where it's just not continuous pressure. And also I think it's
Mhm.
important to pick your handful of people that are important to talk to. I have a handful of people that I speak with regularly, that I trust, that not necessarily think the same way I do, but we have an ability to kind of, hey, what do you, I'm looking at this, or they say, they tell me what they're looking at. There's a handful of people, but it doesn't need to be this continuous stream of people in the industry talking about this chatter about what's hot, or what the next rotation is in the market.
Mhm.
So controlling your environment is really, really important. And sometimes that can mean, maybe for some people it's being in a remote area, or maybe for some people it's being in a family-oriented environment. I mean, the person that did this best was Buffett. And
Mhm.
the first time I went to Omaha, like a lot of first timers many years ago, went to go see his home, and it's just an incredible experience because you think, right, this is somebody who's learned how to control their environment, and they love where
Right.
they and he loves where he lives, and so by doing so, you filter out a lot of the noise that you would have in other places. And so there's nothing wrong with living in New York. There are New Yorkers and people from Manhattan that's their home, and they feel actually most comfortable there, and that's probably where they should be. But you really have to search deep down and say, am I here just because it's supposedly good for business? Or am I here because I really want to be here, and it's a reflection of my personality and who I am, and where I can get the most out of it? And especially if you have a job where you can work from anywhere, or where you have a job that's a
Mhm.
mental job where you have to think a lot, trying to find that balance. And I think that over the years, there'll be something different. My wife and I will probably live somewhere else, and move around, and find there'll be a different place for a different stage, for the different stages of life. So anyway, that's my 2 cents, and I think it's also it's very important. And again, this wasn't possible, 30 or 40 years ago. I mean, if you wanted to be in the industry, if you wanted to be a successful investment manager, you had to be in one of these major cities. And San Francisco might have been a
Right.
distant number two. In America, you almost had there was
Mhm.
this pressure to be in New York or something. But today, you can find, especially looking in America, you can find extremely successful firms in almost every state, and in
Mhm.
all kinds of cities, small cities, large cities, tier three cities. Um, so I think it's okay now, and I'm really grateful. And that's, I guess, one of the benefits of COVID. It made it okay to kind of work where you feel most comfortable.
I think you're onto something. I was on a walk in New York not long ago, and It was a longer walk around Midtown, and I was thinking that I have some association with every building and almost every restaurant because there was an idea dinner or an idea lunch or an event, and it's such a stimulating
Of
city
course.
that you're just immersed in it. And I have images of people that I saw in which venue. All kinds of memories come
Yeah.
back, including being in the Lehman building a few days before it collapsed. There was supposed to be a
Hmm.
conference, and there was an invitation still to that
Hmm.
conference. And I went, and the whole building was empty. There were people very anxious in some rooms discussing things behind closed doors. They shut the door when I was passing by, and I asked the security guard, I had this event. I showed him the invitation. He says, I don't think it's happening. There's something else happening here. And I still get chills thinking about that day because I think the announcement came out a few days after that Lehman went away. But anyways, it's such a
Yes.
stimulating city. My wife and I left New York during COVID in the first few months and spent some time in a cabin in the woods in Pennsylvania and then in Georgia. And I would still open my laptop at work, but I had this experience of finally hearing my own thoughts, which is such a peculiar
Mm.
idea that nobody
Hmm.
else was disturbing me unless they called me or they asked for a video call. But it was just
Yes.
me thinking, reading, and I think that allowed for a much better way to navigate a very difficult period. I took calls from clients. They really
Yes.
appreciated me being available. They said that they just wanted to hear my voice in moments where it was
Yes.
stressful for all of us. We didn't know what's next. Like
Yes.
nowadays, maybe
Yes.
we'll look at it differently, but in the moment when the story was developing. So that environment really played a huge role in me being able to both deliver better work, but you mentioned balance,
Yes.
just being able to go for a walk, be outside. All those things are priceless, and they come
Yes.
with the environment. Jeremy, I want to ask you about being an outsider. When I'm thinking of you, I'm thinking of myself. I might have mentioned to you how so many times in my life I felt like an outsider. I was born in Poland. I went to schools around Europe. At some point, I served on the board of my school in Paris as a student, as the only non-French student. And 2 years later, I was pitching a
Hmm.
stock in New York to a conference room full of people, and I was the only one not born in the US in that room, which dawned on me halfway through my presentation when I realized I don't get all the cultural references, and especially ones related to sports. I still don't. But anyway, I felt like I'm bringing in a different perspective because I haven't walked your path in those rooms, and I realized what I thought was my
Hmm.
disadvantage actually can be turned into an advantage in the investment world because you want to have a different perspective. I have a feeling that you like being a bit of an outsider, even the fact that you joined the investment world from the outside, then you tried to do it on the West Coast when you were told it's the East Coast, and now you're spending some time in Europe. Tell me more about the benefits of being an outsider.
Investing is hard, and it is, but it's an industry where people feel like they can do it too. It's a strange, but
Mm-hmm.
I think when you watch professional sports, at least most people don't watch professional basketball or soccer or football or any sport or tennis and say, okay, I'm gonna get off this couch and I'm gonna go play to that level tomorrow. I mean, there's this sense
Mm-hmm.
though in investing that, well, I can do that. I can press the button. I can buy that stock. I can sell that stock. You just have to look at the pre-market. If it's down, you sell. If it's up, you buy. I mean, it's
Sure.
it's incredible to me how this industry over everything else. Um, when the guy's cutting my hair, I don't think like, oh, I could cut. I could do this myself. Like, just hand me those scissors. I don't need to pay you the 25 dollars, or whatever it is. Like it, or if I'm at a restaurant, I'll say I could, cook this myself. Like, what are you doing? And so, but this
Uh-huh.
industry invites this mindset that everybody you can do it too.
Mm-hmm.
And I'm not saying that I can do it too necessarily either. But
Mm-hmm.
it does take it does take an enormous amount of dedication and work, being willing to fail, being willing to be contrarian, being willing to learn, to pick yourself back up, to think, and evolve. And as Buffett has taught us, it's a business where you accumulate knowledge over your lifetime, and the older you get,
Mm-hmm.
actually, the better of an investor you can become. And you know, being an outsider, what it does is it allows you to kind of continue on that path of recognizing how difficult the business is. And just because, there's people that may fool themselves into thinking because I went to this school or I have a degree from this school or I come from this family or I worked at this firm, that somehow that magically endorses you to be an excellent investor. Because if it was that easy, or if I had an accounting background, if it was as easy as building a DCF or graduating from XYZ top school or working for XYZ fund or investment group before, or even working for XYZ said famous investor, if it was that easy, then everybody would be rich. Everybody would be a billionaire. But it's not that easy. And even when you drill down and look at the most successful investors, and without naming names, there's a lot of people that have become billionaires through just the fee income, not necessarily because their track record is good, especially with the very,
Right.
very large funds.
Mm-hmm. Mm-hmm.
And so I think being an outsider allows me to, one of the advantages is you kind of realize that, wow, this is hard for everybody. And we're all trying to learn. We're all trying to do our best. We're all hopefully learning and evolving and growing. And there's not as much value in that group think, like we were talking about earlier, as maybe other people, that locker room mindset that comes with the traditional group of people in the industry. So, or people that are maybe on the inside, so to speak. What I do think helps being not being an outsider, and in all honesty, is raising money. I mean, it is much easier to raise money when you have the background. If you meet with 100 different, institutional investors, for example, or even family offices, or even high net worth individuals, and they can't check that mental box of, well, he went to this top school and he worked for XYZ said major fund. When you can't check those boxes, it does make it more difficult, because there's this sense of, well, what's wrong with him if he didn't work for those companies before? But being an
Right.
outsider, you understand that that's actually not the key to having a long term, a good long term track record. Um, you have to be a contrarian in order to try to beat the index. You have to be willing to be uncomfortable. You have to be willing to take risk. You have to be willing to look stupid, sometimes for very long periods of time. You have to be willing to grow. You have to be willing to change. You have to be willing to look around you and say, wow, those businesses that I bought, 12 years ago or 11 years ago for 4 or 5 times EBITDA would be a terrible, terrible, terrible idea to buy today. And looking back at those businesses, the reason they would dramatically underperform the market, they may have beat the market in a 1 year period, but in a 10 or 12-year period, they dramatically underperformed the market because they couldn't grow, because competition
Right.
came in, and the world changed. Things like book
Mm-hmm.
value in a modern company are irrelevant. Things like a PE ratio don't tell you what the future earning power of a business is. That kind of learning and that ability to be humbled, I think is maybe you don't necessarily have to be an outsider, but being an outsider, it might help, because you don't have this group of people reinforcing that you should be godlike, because you're one of the few fortunate insiders.
I remember those days standing in the middle of Grand Central, catching a train in New York to the suburbs at some point of my life. And I looked around how everybody was dressed the same way. They even walked the same way. They had the same pace just to fit in, to make it to the train. And then I was thinking, once they make it to the office, and let's say they're in the investment world, what makes me think that they would have any original ideas if their entire life is about merging and blending in and looking like everybody else? And they
Mm.
probably went to the same schools and they live in very similar neighborhoods. So when you have this kind of experience all day long, how come you think that you can sit down and come up with an investment idea that's a bit different and maybe completely out there, where you see an opportunity where nobody sees it? So I think that's this moment where you realize, when you want to be successful in the investment world and do something different and better, like the whole environment has to change, and you kind of choose to become an outsider. Buffett was working in New York for Graham, and at some point he decided to go to Omaha. That's one of many examples. I'm thinking of John Templeton moving to the Bahamas, and how he claimed how changing the environment
Yes,
allowed him to
yes.
perform better. but they chose to be
Yeah.
outsiders in a
Yeah.
way, and it's fascinating how that actually
Yes.
improved their work. You shared with me something that I would call true passion for investing. You know, we say how a lot of people think they can do it. I think a lot of people, or if not all of us, would benefit from being owners of businesses. And even if it's not your business, owning businesses for stock ownership, I think it's a great blessing to all of us, even if you don't choose to become a stock picker. And I don't think everybody has to become a stock picker. But big picture idea for somebody that commits their life to investing, a true passion. You said something that really uh, hit a chord, and I had to make a note and come back to it with you here, and I hope you allow me to bring it up. But you said you have to be willing to starve to death to do it. That's how you feel about investing. And I couldn't stop thinking about that sentence.
Y-
So if you indulge me, tell me
Yeah.
more about that
Yeah.
feeling,
Yeah.
because I feel exactly the same way. There's nothing else I would rather do.
Well, if you look at anybody that's been successful, they usually have paid the price for it.
Yeah.
I mean, there's always the exception of somebody who was kind of born rich and they just had it easy and had endless amounts of capital and everything was easy. But for the most part, if you look at it, like I was looking or watching an interview with Tom Cruise or Tom, no, Tom Hanks, and he was had no money, typical actor story, but he took every part. He got up every day and worked for free almost, and he took every part he could find, even if it didn't pay anything, even if he thought it didn't go anywhere, and he just did this over and over and over and over again, and built relationships and got the experience, and didn't ask how much it paid. He just wanted the experience initially. And I think it's, any being in any business is hard, but especially in the investment business, you have to be so passionate about it because it is hard. You have to be so passionate about it that you're willing to work. That this is the only thing you would that you would ideally, this is the only thing that you would like to do for money. And when I realized that this was my calling and this is really the only thing I wanted to do for work, that I could do it on Sunday if I was not feeling well. I could do it at 6 in the morning. I just had energy to do it, to think about a business, to read about a company all the time. It starts to be, something you can't put down, and you find yourself you're going to do it regardless if somebody is paying you an hourly rate or not, or if you're employed to do it or not. You're gonna do it. You're gonna be getting better. You're gonna be reading. You're gonna be passionate about it, just like an athlete would be passionate about it, or an actor, like I said, or a famous chef. Listening to their stories of working for almost nothing to work for another famous chef or get the experience in the kitchen. It's very similar. So I think that if you go into this business because you want to get rich, that's great because ultimately there is some yardstick and you ultimately will make money, maybe more than the average
Hmm.
entrepreneur if over some period of time. But it would be very disappointing if you just did it to get rich, especially to get rich quick. We all know the story of Warren Buffett. I saw a table recently that showed his net worth per year starting when he was 10. And you see the spike where he didn't really, whatever the quote is, he didn't become a billionaire until he was in his 50s, but he's the best that ever lived,
Right.
and that was a long time ago. It's still a lot of money, but that was really a lot of money, 40 years ago or
Hmm.
something, 45 years ago. But you see that line, of think about his net worth, and it just kind of bobs along the bottom and just sort of looks like it doesn't really move that much, and then all of a sudden, 30, 40 years, 50 years into it, it just spikes, and it's that compounding, and I think you have to be wired for that. You can't find your identity in um, being necessarily being rich or being richer than someone else. You have to be passionate about it and want to do it regardless, because markets go down, stocks go down, investors come and go, and so if you don't have that passion to do it, even if you're gonna, like I said, starve to death. There was an interview with Buffett and Gates, I believe a Charlie Rose interview, and Buffett said something along the lines of he knew that this would be the business this was the business for him. He said even if somebody had just put bread underneath the door, He and just to keep him alive, he would have still just been there working, and that resonated with me. I think you have to feel that way about the. Obviously, it's not practical necessarily, but you have to feel that strongly about it because it is hard. And if it was easy, everybody would be successful, and everybody would have owned Apple since the 1980s, and everybody would be a Google millionaire, and everybody would just be kind of hanging out doing nothing. So it's not that easy, and so that's where the passion has to come from to keep you going.
And, and it's not a short-lived passion that, oh, I'm curious about it now. It's a passion you have to keep alive for decades. And that's when the compounding that you
Yes.
mentioned really starts to kick in and make a big difference in a huge way. And for Buffett, I think you make an interesting point. I don't remember the exact numbers that he made 95% of what he has after the age of 55 and like 99, even
Yes.
at a different point. So the majority of it happened later in his life, right? And it's very different than the tech billionaires that we know that become the richest at the age of 27. It's a very different mindset. And
Mm-hmm.
to me,
Mm-hmm.
the technical side, a lot of people can learn and a lot of people can understand, but to have the passion to show up day after day when it's not always fun for most people, I think that's what
Yeah.
really allows some people to have the staying power and make a difference in the long run, seeing it as a lifelong pursuit. And you can't really fake that kind of passion. I've been thinking a lot about incentives. We want to pick CEOs that are doing certain things that we like as investors and so on. And I had this long conversation with Christian Billinger, who runs his family money out of London. And we talked about the soul in the game, the pride in what you do. And I mentioned to him that what we're really looking for is something that's not for sale, right? You're trying to buy a business with the management or pick an investor with the kind of passion that's way beyond financial incentives, right? You don't want to create, the point is
Yeah.
not to create the carrot and stick so that this CEO shows up at 5 a.m. every day. No, you already have to find a CEO that for one reason or the other loves the business so much and is already rich enough to have anything they want in their life, but they still show up at 5 a.m. and they will still make this product service company better, bigger, whatever the
Yes.
objective is, no matter what, right? And that's really not for sale, which is a very hard concept to embrace in a world
Yes.
where everything has a price and everything seems to be for sale. But what you're really looking for in this extremely great business, it's something that's not for sale. Which brings me to another question, which is what kind of businesses you look for, Jeremy? And if you can share with us a little bit about your investment strategy, how do you find those special, unique opportunities?
Mm. Mm.
And you don't
Well,
have
the
to name
investment
any names.
strategy,
Just
like, yeah, sure, sure. So what I do today, is a little bit different than the early days of just kind of shooting the fish in the barrel with cheap stocks. Um, it's evolved to a place where I'm looking for a business that I can own for a long period of time, and let
hmm
it compound, and um, and also beat the market. Maybe not every year, maybe not consistently beat the market, but that stock, I need to believe that if I buy it, if I'm owning it, if I'm underwriting a return that can beat the S&P 500 over some period of time, over 3 years, over 5 years, and there's kind of two components to that. One, you have to understand the businesses you're competing with in the S&P 500. So I think part of my evolution was looking up and saying, okay, why is the S&P 500 so hard for most people to beat? People just kind of, there's a bunch of tech stocks at the top. I don't need to look at that. That's not what I look at. But you kind of have to look at it and say, well, the businesses at the top that run the index and that have run the index since the beginning of time, going back to the 1970s or 60s, where I have some data, actually did a Value X presentation on this at one point, um, showing that the top businesses at any given time in the index are there for a reason. They're not just there because
right.
people like them. They're there because they have an incredible earnings power. Maybe that doesn't last forever. Obviously, IBM is no longer at the top, and ExxonMobil is no longer at the top today. It's Microsoft and Google, and just kind of understanding what your competition is, and then thinking about kind of where we are and what is going on in life and what's happening out there. We're in a point where change is happening so rapidly, technological change in particular, and businesses that once believed to be, just steady Eddie, and just every year they raise prices 5%, they just keep going. I mean, these businesses are being disrupted in ways that we didn't think that they could be disrupted. Buffett talks about change is the enemy of the investor. But I think in his time, it was a much easier to find businesses that weren't subject to extreme change. And today, business cycles are much shorter. Business life cycles are much shorter, and the business cycle and the business's lifespan themselves are shorter. And it's not just necessarily software that's disrupting. It's just the way we live. The way young people, the way they live is different than one or two generations before. And the way we consume things is changing very rapidly. So it takes businesses potentially out of the game, out of the growth game, and makes them not able to compete.
Mhm.
So in a nutshell, we're looking for businesses, or I'm looking for businesses that can do the rare thing of, we call it survive and thrive. And it sounds kind of funny and cliche, but what that means is when I look at the landscape of businesses out there, I see plenty of businesses that can survive for a long time. Very few businesses in the S&P 500, for example, or any business over a billion market cap that doesn't have a lot of debt, would I look up and say, this is not good. This is going to go to zero, or it's a donut, and it's a donut in 5 years or 3 years. There's many companies that will probably survive. The other hand, you could probably
Right.
find many businesses that are thriving and growing really quickly, but the survivability is in question, or it's difficult to understand the survivability of that. What is the chance this business will be able to continue to to thrive like this, to grow like this? And so what I'm looking for is a business that has both of those characteristics. And the market being as efficient as it is, when it's not inefficient, um, you need to be able to, I need to be able to look into the future and say, what is not priced into that stock? What is not priced in the future? Because when you buy a large mega cap business, like a large consumer business, let's say, for example, that's fully optimized and in a very mature phase, the chance that it's going to be mispriced is very, very low. And when you throw on, the cost to run a fund, or in some people just have a management fee, other people just have a performance fee, some people have both, but anything on top of it in an unlevered portfolio, it becomes very difficult to beat the market unless you can find something about that business that is not priced into the future. So the more clear the business is, or obvious, or consensus that business is,
Mhm.
the harder it becomes to have that business outperform. So we're looking for businesses that can do both, and it usually involves some degree of being uncomfortable. It involves being able to underwrite the trajectory and where a business is going, not necessarily where it has come from, but where it is going, and how it might look in the next 2 or 3 years, and developing a framework to own that business, not just watch the quarterly earnings come out, but actually own that business and track that business, and track that investment thesis, and develop parameters for what is critical for this business to continue to grow, and underwrite towards that. And when that changes, sell it. But for the most part, we're looking for those businesses, and I think it's hard to have. You don't know that going into it. You hope that the business you buy has those characteristics, and you think that it does. But as you own a company, as you know, the longer you own it, the more sometimes you realize, like, wow, this isn't the business I thought it was going to be, or wow, this business is actually way better than I thought it was. And um, so we're tweaking the portfolio towards that, and then still do special situations from time to time. A little bit of maybe like a version of maybe a merger arbitrage or stuff like that. I mean, every now and then we'll find a special situation in the portfolio that think is really interesting, a deep value situation. But for the most part, looking for businesses that we can buy and hold that I think have a good chance of beating the index, and for the right reasons.
I like that you mentioned being uncomfortable. I think it's the essence that sometimes the best ideas actually make you very uncomfortable. I remember pitching ideas
Yeah.
as a younger analyst to a room, and whenever there was an idea that everybody felt comfortable with, I felt like I missed the point. And when I had a room that was really uncomfortable with whatever I just recommended, I thought I found something that really smart people disagree with me about. And I think I
Hmm.
found something
Hmm.
that really is outside of the consensus. So these are the things that I think about. You brought up something interesting that I've been thinking about a lot, and you know about it, how I was thinking about 20 stocks for 20 years, this kind of a big picture, mental experiment.
Hmm.
And when I ask people about those, what kind of stocks they would pick for 20 years, the first answer is what you mentioned, is the companies that will survive 20 years. But I say, no, 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 that's not what I'm asking about. I'm asking about businesses that will take advantage of those 20 years, companies that are worth the wait. And I think that's what you're looking for. You want a company that will
That's right.
make a difference in the next 20 years, and somehow it's not fully
Right.
understood by the world just yet. I think that's where the true treasures hide. But 20 years, it's way beyond most of people's investment horizon. And I manage money for families, and I know that you work with generational wealth as well. These are the
Hmm.
clients that have the patience to see this huge, huge improvement and growth in certain businesses. And it's a very different game than trying to guess what's going to happen in the next 12 months. Very different game. I want to bring up a quote that you mentioned in your writing from Peter Lynch, that his name came up in our
Hmm.
conversation more than once. He said, "It's not about the
Hmm.
brain, it's about the stomach." Tell me more about the emotional journey that investing can be,
There's a
as much as you want
well,
to share.
if you haven't, there's a famous Peter Lynch video that I think, I don't know, hopefully everybody, a lot of people have watched, but if you haven't watched it, just Google Peter Lynch video, and he's giving a speech on a podium for about an hour. It's very famous, but he gives an example of Taco Bell. But in the beginning
Uh-huh.
of I think the beginning of the talk, he talks about how stocks will go down. That's just the nature of it. So let's just
Mm-hmm.
get that out of the way. Like, just because you buy a stock doesn't mean it's going to go up. It probably, when I buy a stock, it usually goes down. So you volatility is part of the game, and if you can't handle that, then you shouldn't own stocks. And Munger says, if you're not willing to go down 50%, then you're not worth the investment. Right? He says something, you shouldn't be an investor, something along those lines. I'm butchering the quote. And Peter Lynch goes on to talk about, for example, Taco Bell. And he said, it was a great deal at $14. And in 1972, it went from $14 to $1. So it was down, I was 92,
Ouch.
93%. And
Mm-hmm.
you think, like, oh my God,
Right.
that's crazy. So tells a story
Mm-hmm.
about buying it all the way down. But he said, there's no way this company's going bankrupt. It's growing like crazy. It has it does no debt. And, it was during like the fast food boom. And the reason
Mm-hmm.
it was going down is kind of what happened to us, and what happened to the market in 2021. Us as the market 2021, 2022, when the Fed started raising interest rates, like there was just tons of money sucked out of the market to go buy bonds. And
Right.
and in the 70s, it was much more extreme. It was a kind of an extreme version of what we went through the last few years. So
Mm-hmm.
I guess companies like Taco Bell were down 90 something percent from what he paid. So he talks about buying it all the way, maybe not to one, but he buys it at 14. You have to watch the video. I don't remember. It's at 14, and then at 8, and then at 7 and 6. And he said it's just part of it. And so was he wrong? Because it went down 93%,
Uh-huh.
or was the market just mispriced? Well, it kind of depends on who you talk to. It depends on how you've set yourself up. It depends on who your investors are. And if you're
Right.
thinking like a business owner, you're excited about that.
Mm-hmm.
You're saying, of course the market's wrong. Like, we can do the analysis, we can do tons of work on the company, and we can clearly see that this is not a distressed business, but the stock is down 93%. So we actually want to buy more. And then he follows on to make the point that 6 years later, in 1978, um, Pepsi buys Taco Bell for like $42 a share. And the best part, so I don't know what his cost basis was. So let's say he paid the $14 and he made 4 or 5x, whatever that 4x return. But it took 5 6 years, and
Mm-hmm.
5 or 6 years is a lifetime when you're running an
It
investment
is.
business. It's a lifetime, because every quarter goes by, every month goes by, every year goes by,
Uh-huh.
and you've underperformed. And you're saying, no, but let me show you how cheap Taco Bell is. I can't believe, and look, reading, and I just kind of read around the internet kind of what, after I listened to that talk the first time, um, that Pepsi paid $125 million for Taco Bell, which seems absurd. It seems like such a small amount of money. So when the stock trade, that was at $42 a share. So at $1 a
Right.
share, imagine what the equity value of Taco Bell was in 1972, almost nothing. Now, maybe they didn't have a lot of stores. Maybe they only had 50 or 60 stores. But the
Mm-hmm.
best part about that story was, Pepsi paid in stock. And I believe it was like 1.4 shares per Pepsi or
Uh-huh.
per Taco Bell share. So and that
Uh-huh.
ended up being much more than a hundred bagger if you held the stock without dividends.
Mm-hmm.
So with dividends, who knows what the return would have been? More than much more than much greater than a 100x return. But that would have required
Mm-hmm.
holding, for the next 40 plus years. And
Mm-hmm.
that's what the essence of real, when I think about the great investors, that's what I think about. I don't think about the pod shops. I don't think about people that are trading or people that are up this year when everybody else is down. I don't think of people that pivoted before the Fed or pivoted from oil to tech or tech to oil. I think about people that can do that, that can recognize, wow, Taco Bell is an amazing buy at 14, and it's
Mm-hmm.
even a more amazing buy at 1, and get excited about that because they've developed the conviction of studying the business to be able to buy and hold. And in a perfect world, go to those family office or family and partners and say, now is the time to add capital, and have them add, and not say,
Mm-hmm.
let's wait until the year returns go back up again. Let's wait till Pepsi actually acquires it for $42. Then we'll give you more money to go do it again. No,
Mm-hmm.
you want a situation where you have the ability to do that. And the reason he says that the business is more stomach than brain is because all the
Mm-hmm.
brain power in the world, all the DCF models could have told you that Taco Bell was a buy, and it still didn't matter because owning it would have required showing a mark to market loss of 92% from that $14, which turned out to be an enormous discount to where the business was ultimately sold just 5 years later, which was an enormous discount to what the value of the stock would have been of Pepsi that was the currency used to buy the business. So, yes, that's a home run, but I think his point is that most people are not successful with stocks because they don't have the stomach to deal with it. They don't have the stomach to deal with the fact that stocks can do anything in the short term. And they let the price of the stock dictate the narrative of the thesis, which means that as the stock goes down, there's this halo effect where all the bad news starts coming out. Rob Vernal talks about this on one of his 15-year anniversary letter. If you follow RV at all, is a
Mm-hmm.
wonderful manager to follow. I enjoy following his letters. He talks
I
about
know. I know him.
something very similar to this concept. Something
Mm-hmm.
very similar to this concept of it's a very emotional business because
It
things
is.
can get crazy, and when things are down, the bad news comes out about that stock. So as the stock goes down, the more and more and more bad news comes out, and as the stock goes up,
Mm-hmm.
more and more and more good news comes out. And so investors start to think that they're wrong because they watch a stock go down every day, every day, every day, every day. And there's a point where this concept of reflexivity kicks in. George Soros talks about, um, where you actually start to believe that, okay, maybe I am wrong, and in some cases you might be wrong. So to be able
Right.
to find that place where you can develop conviction, built around a specific thesis, and as long as that
Mm-hmm.
thesis is intact, um, it's just the price to pay for admission. It's Monish Pabrai
Mm-hmm.
talks about this idea of buying an apartment, and what if every day you had to get a bid on that apartment after you bought it? Well, he
Painful.
says in one of his lectures, he says, what if you went back to the broker and said, well, now what is it worth? And they had to give you an estimate. And now what is it worth? And they had to give you, and they said, well, I don't know. Maybe it's gone up by 2 or 3%. I don't know. I mean, imagine if that's how you had to own
Mm-hmm.
a private business. So, but this is what's happening in the stock market on a daily basis. As Ben Graham famously said, it's a voting machine in the near term, and markets can get very, very irrational, like they did in the 70s, and like in some cases they did in 2022. Not that there weren't things that were overvalued, but there were. We can look back at 2022, and a lot of the things people really thought were just deserved to be permanently down and never should have gone up, a lot of those have gone back, and they're at all-time highs above where they traded in 2020 at kind of peak euphoria, because they were very high quality businesses, and there are others that didn't obviously return to that. But so this is the game. The game is more stomach than brain, because a spreadsheet and a DCF is not going to prevent the stock from going down 50%. It's not going to prevent wild things from happening and from you feeling like you've lost your capital, even though you may
Mhm.
not have lost your capital. You only lose your capital if you sell. So it's hard.
I I love the sound of that. And I had Chris Mayer on the show twice, and he wrote the book about 100x stocks, and Phelps did
Oh,
studies about 100x stocks.
incredible.
Fascinating book, and Chris is a wonderful
Yes,
guest and a friend.
wonderful.
But the idea that people miss is that what does it take to hold on to that stock that you found that could be a potential 100x or 50x or 20x? It takes not just the brains, but a lot of emotional resilience. You'll be talked out of it, you'll be tested, and the price movement will make it even harder. When you flip it on its head, though, the ability to find a deal in the public market might be better than in the private market, because you do have moments when the crowd overtakes what's happening and creates
Yes.
huge discounts that are harder to find in the private market. So that's something that I like to point out. But anyways, to capture the 100x, this will take much more than brains, and I think that's a good reminder. Jeremy, I want to ask you about your definition of success before you go, but very quickly, I'm curious about having a community, a network of people, and Value X for you and I
Yes.
has been a wonderful experience. The reason
Yes.
I bring it up, we've been talking about being an outsider, we've been talking about kind of being on your own in this pursuit, but at the same time, we both value, and many of our friends value, having a community of people like you and I, to be able to reach out and talk to in moments when this pursuit feels very lonely. Tell me about your
Mhm.
10 years with Value X real quick, and why it's so important to have people like that in your life.
Well, yeah, Value X is a great community. I've been going for more than maybe at least, maybe 10 or 11 years, something like that. I I like it because I like Value X because it's a diverse group of people. It's not just investors. People are interested in investing. Everybody's there for investing, but you have a wide variety of backgrounds. So it's not just everybody's not running a fund looking for, I don't know. So the ideas come from different walks of life. There's a lot of entrepreneurs there, and there's academics there. There's kind of a range of people. But I think it's important, at least in my life, I've found to have a wide range of people that I interact with just a wide variety of backgrounds. Because what it does is it prevents me from being so lopsided. If all my
Mm-hmm.
friends did the exact same thing that I did, I think all we would talk about is picking stocks. But because, with a little bit more diverse group of friends, where the thread in common may be personal things, or it may be just the way our value system, for example, the things we value in life. I get a lot out of that because it allows me to be a little bit more balanced, and be operating in a business that you could easily not be balanced. It could easily be
Mm-hmm.
all consuming, and it is all consuming, but it could easily not be balanced if you let it. So finding groups of people that have maybe an interest, but coming from different walks of life is very powerful, and it allows you to draw on different experiences that people have, and see the world in a different way. And obviously that translates through to investing. I mean, there's been many cases where I just didn't have a frame of reference, or an opinion, or maybe even a bad opinion about a market, another part of the world, or about why an economy was doing what it has done, or even a particular company, and the having that feedback, or having that ability to talk to people that are coming from a very different background, allows you to think through it in a different way. And I didn't think about it like that. Thank you for sharing, or helping me understand the cultural nuances of why this company reports the way it does, or the history behind it. So even if we're not talking stocks, you can sort of, I don't know, learn about things that ultimately apply to your investment lens, and widen your scope of thinking. You know, your your circle of confidence in a way can grow that way. So yeah, having a diverse group of investor friendly people is very important to me. So glad to be a part of it.
I, yeah, I agree. It really plays a big role to have a network of people around the world that are alike in so many ways, but different in so many other ways that it makes it a very rich
Mm,
environment, but also a space that we all, I think, feel safe to share things that maybe we wouldn't bring up in other contexts. Real quick, Jeremy, I know
yes.
I'm not going to let you go without
Yeah.
sharing your definition of success. How do you think about it?
Uh, um, so I think that for me, success is having the ability to think freely and have a free mind.
Hmm.
And what a free mind is the ability to the flexibility to be able to work on and become a better to be better at different phases, different things in life. So become a better husband, a better father, a better investor, and to be able to have the space to be able to work on that and to think through issues, to be able to evolve, to be able to grow. And if you don't have a free mind, it's very difficult to do that. If you are constantly fighting for time, mental space to I don't know, just do very basic things, or in very extreme cases, think about people that are living in a war zone, for example, like they don't have that mental freedom to be able to work on themselves, to be able to grow, to be able to evolve. So when I think about success, success for me is having that free mind, and that doesn't mean a retired mind by any stretch. That just means a mind that is able to be free enough to be able to grow and evolve and become and allow me to evolve and to become better at the things that are most
Hmm.
important to me, not only my career but family as well. And so it's not necessarily a financial yardstick. And financial stuff is obviously very important because you need to have be able to pay the bills, I guess. But beyond that, putting myself in a position to have a free mind is and maintaining that for as long as possible is the way I think about success.
Well, I love the sound of that. And I know that you've been creating this environment for you to flourish, where you can spend time with your family, but also pursue the true passion that I know investing is for you. You're one of those friends that I have that they can't think or do anything else other than investing. And I love seeing that in people
Yeah.
once they discover it. And I feel the same way. There's nothing else I would rather do. Jeremy, thank you so much for today. It was such a wonderful conversation, and you and I had so many conversations that were never recorded, but I feel like I gave my audience a glimpse of Jeremy that I know
Yeah.
today, and I'm really grateful for that. So thank you.
Thank you for having me, Bogomil. I really really appreciate the time, and thanks for having me on.